Hi everyone, my name is Dylan. I'm an investment consultant here at iFast Global Markets. And today I'm also joined with Dexter, one of the senior fixed income analysts in our team. So as the name of the title of our topic today suggests, it's to maximize returns in this low yield backdrop environment with a bond portfolio, right? This year has been quite a year of volatility with lots of things happening from COVID to US elections, even Singapore elections for all that, for that matter, right? So with so much going on, for seasoned investors like you and I, we might be wondering, how to better position ourselves in such an environment and how we can actually go forward building our things. Right. So this is where we believe, the asset class of fixed income and bonds really come into play to offer that kind of stability and that kind of risk, dampening, risk mitigation kind of effect. And that's really what we'll be exploring today. Okay, so onto my first slide. Just give me a second. So before I begin, this is just the standard disclaimer, just to let you know, anything in particular, you can read it in your little quick glance way, but this is just something that we have to do based on our compliance procedures, right? All right, so let's just head to the first slide. So let's just give you an idea of who we are. We are Bond Supermart and iFast Global Markets. So basically, we are the fixed income and the investment advisory arms of iFast Corporation. Right, iFast Corporation is a company that was is a fintech company that was listed on the SGX a couple of years ago, and we just crossed our 12 billion AUA mark as at, I think, end of September. So we've been growing quite a fair bit in terms of our asset base, and especially from our bonds business, this is really what we seek to do for our clients, right? From the Bond Supermart aspect, we have a whole suite of investment tools. So whether you want to find bonds, select bonds, create a little watch list for yourself, that's what we have over here on our platform. But we also update these, bond tickets with all these related information, whether is it about the company or the issuer that's issuing the bond, whether there's any credit updates or any like material events that might, affect the bond pricing, right? That's where our analysts will come in and conduct the due diligence, and then that's where we'll update you in terms of our content as well. So really, we are a whole multifaceted fintech solution provider when it comes to investing in the fixed income space over here. All right, so this is just a little bit about who we are, and let's go on to examining this year of what it really has been. So I think by now you should be quite clear with this graph. I think as seasoned investors, if you were invested in the equity markets this year, we were all happily enjoying our Chinese New Year holidays, right? A little bit of further rallies from the beginning of the year all the way through to February. And then the moment March hit, that was where we really saw like the massive sell downs due to the coronavirus impacts, and that was the depths of where it was, right? And then slowly since then, through the days of our lockdowns, we've started to see, central banks kick in with record amounts of fiscal stimulus and monetary stimulus as well. They have also cut interest rates to all-time lows, which is also presenting another problem for us income seekers, right? So since then, our equity markets have recovered, although it's not also a very clear line. It's lots of volatility, as you can see in the graph over here, lots of bouts of ups and downs. So really, it's about how, the topic of today, having seen all that, is how to really position our portfolios, going forward, okay? So I'm just going to bring you through a little bit of the macro bit here. So you don't have to worry too much about the wordings. It's just for, your illustrative purposes and more details if you want to see it. But if you to focus on the right-hand side charts over here, you see that world GDP growth rates have actually been largely revised downwards for 2020, right? So this is actually even worse than what we saw back in the year of the great financial crisis about 10 years ago, right? So this is really an unprecedented scale kind of a crisis that we've never seen before. But having said that, we do expect, with positive vaccine development news, with, the US elections way past behind us, we do expect some positive growth in the year of 2021 and ahead, right? But whether it will be a straight line up or it's going to be a jumpy route, that's going to be, remain to be seen. So, and of course, one more thing to note is also another record level of U.S. unemployment, even dating back all the way to 1990s. We've never seen this kind of level of unemployment before, right? So this global recession, which was led by the COVID-19 pandemic, is currently still here to stay. Although we're seeing some glimmers of hope at the end of the tunnel, but really it's how to further position our portfolios going forward. All right. So the implications of real low rates, really, I think one of the worst things that can happen right now is that, your income level falls, right? So with interest rates in your bank loans giving you like maybe like 0.6%, your fixed D rates, right? At this kind of date, I don't think it's really worth putting a large sum of money to generate a kind of low yield in this kind of low yield environment. So as you can see in this bottom right hand side chart over here, the rates all around the world, not just in Singapore, okay, the rates all around the world are at record lows, and they've been cut by the central banks to kind of alleviate the tight monetary conditions, right? So because of that, a weak interest rate environment is not going to be very supportive of your income generating, your fixed income environment, your portfolios. Sorry. So, with that said, we do still see a very good position for having bonds in your portfolio. So if we were to take a little flashback, right, the blue line over here represents global stock markets, right, as represented by the MSCI World Index. And the orange line here represents the global bond market as represented by the Bloomberg Barclays Global Aggregate. So dating back all the way to 25 years ago, about 1995, you see that equity markets have their ups and their downs. And then we've seen three major crises in the last 25 years: the dot-com bubble, the great financial crisis, and right now, of course, the COVID-19 pandemic, right? So although it's a straight line up, it didn't come with its bouts of volatility as well. And there were years that, for example, if you see the years of 2000 all the way through to 2003, right, it was actually a downtrending line for quite a fair bit of time. But the interesting thing that you note in these periods is that, the orange line continued its stable trajectory upwards, or at least it didn't move at all. So this really is, the big proposition that we have for you today, in the sense that you can't just, when you're invested into, global financial markets, you can't just be invested into global equity markets, because you don't know when the next crisis is happening, and you have to have some bonds to help to further diversify and to help to dampen the risk volatilities in these kind of periods, right? So with that backdrop and context understood, this is how we're going to bring in the fixed income universe today. So you see that in the fixed income universe, there are many kinds of bonds all over the place, right? You can buy your bonds based on the kind of issuing company, be it whether you like a big government treasury bond, or you like maybe a high yield real estate property developer. You can even sort them by credit risks. Are you investing only in the AAA standards, or are you taking a little bit more speculative risk to invest in the sub-investment grade bonds, right? You can also play by duration, be it long or short term, and then there's so many other aspects that you can look at, right? So with all that into play, the question is how you're going to go about doing it, right? So before we go on to discuss that, let's just bring you through some of the roadblocks when it comes to bond investing first. First and foremost, the bond prices are not like stock prices. Stock prices, the moment you open up any trading screen, you have the price there, that's what it is. But bond prices are always, when you see it on whatever platforms, they are always largely indicative, and they may not be executed at that actual price that you see it at. Right, so that's the first problem. When you see a price, you may not get it at the exact price that you want. The second problem is actually an illiquidity problem. So you might have experienced this when you invested into stocks before, because illiquidity actually results when in a situation when you want to buy a stock or a bond and no one wants to sell it to you, and vice versa, when you want to sell it, no one wants to buy from you. So the bond market is very, in a way, well known for being largely illiquid. Also because of the next problem number 3, which is the high minimum investment amount. So for stocks, you can invest with, depending on the lot size, you probably can invest with as little as maybe, a few $100s, right? But when you come into bond investing, you always have to buy them in lot sizes of at least Singapore dollar terms 250,000 and above, or US dollar terms 200,000 and above, right? So this is really one of the big hurdles that that it's going to contribute to the second problem, which is illiquidity as well, right? And then last of all, it's the limited choices in the retail bond segment. So I mentioned just now about the high minimum investment amount, but we also have this sector class called retail bonds, where retail bonds can actually be bought in denominations of maybe, in the denominations about $1,000 or $5,000, which are much smaller. But these are not always available, and there are not many available in the market nowadays, especially. Right, so these are the main roadblocks to bond investing, which may kind of hinder, you as a bond investor going forward if you're looking to get invested in the fixed income space. So what we do here to kind of solve all these problems is this platform called iFast Bond Express, right? So as the name suggests, Bond Express means it kind of puts you onto the express line of this supermarket called a bond supermarket, right? So imagine yourself in a NTUC or a cold storage kind of thing where they always have an express lane for single basket items, right? So it's basically to fast track you to make it a little bit more efficient so that you don't have to wait, you don't have to think, and you know exactly what you're buying into and at what price, right? So I'll just zoom in into three of these points over here about firm pricing and liquidity, immediate trade execution, and the wholesale bonds in smaller size amounts. Okay, so the first one is on the firm pricing and liquidity. So I mentioned just now that, when you look at any broker's platform, the bond prices might not always be that accurate, or may not even be what you are intending to buy at, right? So it's always indicative. But what we over here provide is actual executable prices and volumes, because what we do over here on Bond Express is we actually buy the bonds, the wholesale lot size first, we hold it on our own inventories, and then we list it out to our own clients at specific prices. So you see all these bid yields, price, ask price, yields, and all that, they're actually updated on a daily basis. And what price you get, what price you see over here is exactly what you get. So for example, if you're looking to buy the first row, the bond in the first row, and you're asking, okay, so what's the price that you're going to buy at? You see a 101 here, it means it's 101. Right? And if you're looking for what kind of yield you can get, if it says 6.4% here, then that's the number that you're going to get. So essentially, it's what you see is what you get, right? It's very efficient in a way, and you can get it at a very good amount of certainty. Okay, and then the second issue. So before I go on to that, this is what it really just looks at. Bond Express, we just update all our prices on a daily basis, right? You can see we offer bonds in various currencies, in various issuers, and of course in varying yield levels as well. Okay. So then the next one is the immediate trade execution kind of process. Usually, if you want to buy a bond by yourself, maybe you have to go through a very long process of finding out exactly what's going on, how much you have to buy, whether there's liquidity, and then you have to find some contacts in your own brokerage to see whether they can offer you at that price and at that volume, right? But what we do, because of that trade certainty, because of that pricing and the yield certainty and the volume certainty as well, you see that it actually gets executed in this seamless 4-step process. So we give you the indicative pricing, all right? And then a financial advisor, which you will probably engage in, will advise you on that kind of pricing. And if you are satisfied with that pricing, we will proceed with the bond trade, as you can see in step 3. And then finally, it's just to sign it off, and you'll receive your receipt of payment, and the bond is with you in the next, 2 or 3 trading days. Right, so it's a very seamless trading process over here in iFast Bond Express. And this actually brings me over here, right, to the next point also, which reduces the lag time when you try to communicate. So it reduces a lot of that back and forth going through when it comes to actually finding out about investing in bonds. So you get the price, you see the price, that's exactly what you get. We'll execute it immediately. All right. So, and of course, the last point is about the point on investing into smaller sizes. So I talked about just now investing in bonds, you actually need about 250,000 Sing dollars or 200,000 US dollars, right? But here at Bond Express, we're actually listing these bonds out at denomination sizes of about $5,000 and above. So you can buy bonds in 5,000, 10,000, so on and so forth, right? And the interesting thing is that you can actually take this opportunity to further diversify your fixed income portfolio, where you look at all these are the examples examples of the kind of issuers bonds that we're holding. So you have the banks like DBS and UBS, and we also diversify into healthcare spaces like Thomson Medical Group. And for those of you who are expecting a little bit more speculative plays on the Chinese real estate development space, we also have China Evergrande bonds in our Bond Express portfolio. So it's really quite a fair bit of issuers and a diversity of yields, and it's really at most up to you on how you want to construct it. So really get in touch with an advisor, be it from IGM, an advisor, or BSM. I think that's really something you should engage in, and I think they will be able to guide you on how you can go about doing this. So so this is just our criteria to share with you how we actually pick our bonds, which later on my colleague Dexter will share with you on some of the examples. So you'll see that we examine the macro market conditions, the credit worthiness of the companies, whether they are having sufficient cash balances, whether they are able to pay back their monies on time, the pricing levels, whether it's worth paying that amount of money for the kind of yield that you're going to get. And lastly, we need to diversify across sectors as well. So because we are holding those bonds onto our inventories, we definitely have to do our own due diligence. So you can rest assured that, because we are holding onto the bonds, we also wouldn't want them to default, right? So you can rest assured that if you are buying these bonds, then you are as if investing alongside us. And therefore, we can safely say that, our interests are aligned as we are investing in it together. Okay, so that's pretty much it from my side. I've pretty much shared with you what iFAST Bond Express is and how you can get started on, investing in the fixed income space. And I'll let Dexter right now to show you exactly how you can go about using the Bond Express platform to even customize a bond portfolio for yourself. So over to you, Dexter.
Hi, Dexter here from fixed income. So I'm a senior fixed income analyst. So in the next couple of minutes, I'll be showing you how you can use iFAST Bond Express to customize a bond portfolio. So it's pretty much an extension of what Dylan has shared. Um, but before I introduce the Bond Express portfolio, I would like to give an introduction on the portfolio builder on bondsupermart.com. So we recently launched this tool, and you can actually go to bondsupermart.com to view it. It's under tools, and you can go to portfolio builder. So it helps investors to give a very aggregate view of their portfolio, how the historical performance of the portfolio has been, and then what is the future cash flows to maturities, as well as the various bond informations. So you can go, like as shown here, you can go to chart, and then there's the cash flows to maturities of the portfolio, the bond information like the credit ratings, and you can actually go to bondsformat.com and then you create a account for yourself, and then you log in. So when you log in, you can go to tools, and then you can go to the portfolio builder and build your own portfolios. So within this portfolio builder tool, there's actually other portfolios you can view, like the conservative portfolio, the balance, but the Bond Express portfolio is actually available in there. So in there, you can go to and you can view all the information on the Bond Express portfolio. So there's like 20 bonds in there, and then you can look at the projected cash flows. So it's actually a very useful tool. Unfortunately, I cannot demonstrate it to you right now. But so anyway, the benefits of investing in a portfolio of Bond Express bonds. So number one is that investors get to reap the benefits of portfolio diversification. So downside risk is mitigated against wide price swings that are typically found in a single high yield bond. So when you diversify your risk, your portfolio is allocated to various bonds, and you will not be the portfolio will not be susceptible to like the swings that are found in the single high yield bond. So number three is that the portfolios and the bonds are actually reviewed and updated every month. So there's actually a team of analysts that help to provide a regular update on the bonds. So my colleagues actually have helped to review this every month, and then so we will determine whether the issuer can pay the bond on time, or whether the bond has matured, and then whether there's a need to change the bonds within the portfolio. So point number four is that the portfolios may be customized to provide cash flows in specific months. So with regard to this point, it's so for example, let's say if you have a lot of cash outflows during December or January. So for example, like most of us during Chinese New Year, we have to give ang pao, or during the festive season, we have to spend more or maybe pay our insurance premiums during December or January. Then you may want to overweight some bonds that actually pay that provide the cash flows within these months, like for example in January or in December, they're able to help to offset the cash requirement, the cash flow requirements. So of course, this is not really, it's just a suggestion. Of course, when we look at the portfolio, we still want to look at issuer credit quality and how we can maximize our yield for these portfolios. So these are the bonds in the Bond Express portfolio. There are right now 20 of them. So this is as of end of October. So I'll go through the names individually. So I'll spend a couple of minutes on this slide. Okay. So we have ARTSP. So this is Escort Residences Trust. So there's a hospitality trust that is sponsored by Escort Limited and is a member of Capital Land. So Capital Land is something which we are all very familiar. It's owned by Temasek Holdings, and if you go to the CBD, you can see Capital Land everywhere. Cathay is Hong Kong Airlines, so Cathay Pacific. I think most of us also know this. So apparently, this is an airline. As you know, the airline industry is somewhat in a downturn. But looking ahead, when we have the vaccine, then things will improve. So which is why we also included it in the Bond Express portfolio. And then we have China Evergrande, which is one of the largest real estate developers in China. CMZB is Commerce Bank, so it's a German bank, mainly in commercial lending. And we have DBS, which is one of the top three Singapore banks. ESR Cayman is a leading real estate logistics player, so they have exposure in Korea, Japan, and in China. And then we have Fantasia, which is a Chinese developer that's 10% of the portfolio in the Greater Bay Area, as well as 60% in the River Delta region, and as well as some exposure in Chengdu and Chongqing. Then we have Fosun International, which is the issuing entity is actually a Fortune Star, so it's a wholly owned subsidiary of Fosun International, which is a listed conglomerate on the Hong Kong Stock Exchange. So it's a big company. Then we have Fraser's Property. So Fraser's Property is something like Capital Land. It's also a Singapore listed property developer. So it's also pretty big. It has a lot of exposure in various real estate classes like hospitality, retail malls. And then we have FWD Group, which is a insurer. So this one, FWD is actually owned by Pacific Century Group, and Pacific Century is owned by Richard Lee. So Richard Lee is the son of Lee Ka-shing, so it's a Hong Kong tycoon. Then we have HSBC, which is one of the biggest banks in the world. I think most of us are familiar with this name. Logan Property is a Chinese real estate developer. So they are primarily in the GBA. So the Greater Bay Area is actually one of the fastest growing regions in China. And then we have Manulife Financial, which is the largest insurer in Canada. Metro Holdings, which is a property developer and a retailer as well. So if you go to Paragon, you can see the Metro shop. So they're pretty busy right now during this festive season. And we have Olam International, which is an agribusiness a commodity player. So the revenue for this company is actually more than the total income for DBS. Then Oxley Holdings is a listed Singapore listed property developer. Is a highly geared developer, but it's pretty forthcoming and quite the earnings forecast is quite. I mean the visibility about this company is quite high. So they're pretty transparent about how their earnings and how their cash flows will come in future. So, and then we have Rongshine China, which is a Chinese listed property, a China real estate developer. So they're also quite big in the River Yangtze Delta region. And then we have Futureland, which is also a Chinese real estate developer, with which has exposure also in central and western China. Then TMG SP is Thomson Medical. I think Dylan mentioned this just now. So Thomson Medical is owned by Peter Lim. So Peter Lim used to be the Remisier King. He's one of the richest people in Singapore, and he owns this company. And this company is actually they run hospitals. So they have hospitals in Malaysia and in Singapore. And he's also looking to build a hospital in the Iskandar region. So that is up and coming. And then we have UBS. So UBS is one of the biggest Swiss banks in the world. Okay, so as an investor, we want to maximize our return and minimize our risk. So here we have a mathematical representation of the expected return of the portfolio. So this is this is in relation to my point on diversification. So we want to maximize returns and we want to minimize risk. So of course, this is mathematically. So it's something. It's a very powerful concept actually. Diversification. So if you look at this formula here, so we have the expected return of the portfolio is actually a weighted average of the expected returns of the individual bonds. So this is like the expected return, and then we have the expected return of the bond would be the yield to maturity, which is something which we cannot control. So this is pretty much determined by the market. And then we have the weightage. So the weightage is something which you can control as an investor. So you're pretty much you can determine the expected returns of your own personal portfolio depending on what weights you assign to each individual bond. So we have the variance. The variance is pretty much is a function of the variances of individual bonds. So this is just another way of looking at it. So it's a summation of the various weightages and the expected returns. And then if we look at the variance, it's actually is a function, is a covariance. So when we say covariance, it's also related to correlation. So correlation is something which is also a very um, powerful concept, I would say. So for example, if we have time, so this is time, and then we have returns. So we have the returns over time. And let's say you buy a bond, so you buy a single bond and the bond behaves like this over time. So it goes up and down over time. So here, this bond, it goes up and down over time. And you manage to find another bond which is inversely correlated to the first bond. So these two bonds are negatively correlated. So because they are negatively correlated, it actually moves like this. So what we have here is a negatively correlated bond with the first bond. So ultimately, when you have these two bonds in your portfolio will behave, you will give you a very smooth kind of return over time. So this is your RP. So you see that now it behaves almost like a fixed deposit, but it is like on a higher scale. So a fixed deposit will give you a return something like this. So this is RD. So you can see how powerful it is. I mean, just by finding negatively correlated assets and how you can help to smooth out the returns of your portfolio. So just to illustrate diversification, we can have, so for example, we have two bonds. So let's say we have Evergrande, China Evergrande, and then we have DBS perpetual note. So China Evergrande is rated single B by Moody's, B plus by S&P, and B plus by Fitch. So you can tell that this bond is rather has a higher risk just by looking at the performance of. So this is total returns. So you just by looking. So when the bond is at this point here, so when there was a market volatility, so investors actually sold down this bond quite a lot. So maybe your $1 million investment will become a 700,000 at some point in time. So this is because of the 31% drawdown. So you look at the movement of this bond, you can see that it goes up and down over time. And it's very much in contrast to the DBS perpetual note on the right. So on the right, the 3.6% perpetual note has a drawdown of only 12%. So whereas the China Evergrande is a drawdown of 31%. So if you look at the movements, you see that the perpetual note, the DBS perpetual note has a much smoother kind of return over time. So two bonds are very much in contrast to one another. So DBS is actually double A rated. So it's a high investment grade kind of bond with a high credit quality. So of course, with high risk, you get higher returns. So I'm actually starting from the same point. So this is March 2017, and then you get a higher return. So China Evergrande can go up to about 128, but the DBS will go up to 180. So now when we combine those two bonds, you see the portfolio diversification. So on the far left, we have the conservative allocation, whereby you allocate more into the DBS bond, which is more has a higher credit quality, and then lesser to the lower credit quality, which is China Evergrande. And then if you don't have a view on these two issuers, then it's better to take a balanced view. So you just equal weighted, and then you put 50% in DBS and 50% in China Evergrande. So on the right, we have the aggressive, which is whereby you allocate more to the China Evergrande bond and less to the DBS bond. So so as you can see, the drawdowns for each of these situations, we have 17% in the conservative example, and then 22% in the balance, and then 28% drawdown in the aggressive portfolio. So now we take it one step further. So from two assets, so maybe just two bonds, now we extend it to 7 bonds. So if we have 7 bonds in the portfolio for the Bond Express, so you can take any 7 bonds from the Bond Express portfolio, and then you create your own portfolio. And you see that the drawdowns have actually decreased. So this is based on historical performance, of course. And so this is 15% in US dollar terms, and 9% in Sing dollar terms, and 10% in local currency terms. So now we take another step further. So we diversify the portfolio more, and then we have actually n equals to 20. So here in the Bond Express portfolio, as I mentioned earlier, there are actually 20 bonds in the Bond Express portfolio, and there are a couple of options for you as an investor. You can actually invest 250,000 in a single bond, or you can invest 200,000 in a Bond Express portfolio, so which has more diversification. So it's more diversified across the names which I mentioned earlier. So I would say, I would assume that the drawdown for this portfolio would be much lower than a portfolio with just two assets. So here, I hope you can see that this is a very attractive proposition. So by having a diversified portfolio, you can actually help to have a higher risk-adjusted return over time. So just to give you more information about the Bond Express portfolio, so I wanted to show this earlier on the website, but if here you can see that the Bond Express portfolio has about 50% in US dollar bonds and about 50% in Sing dollar bonds, and 80% of the portfolio is right now is in high yield corporates, and about 20% is in non high yield corporates. And then if we break down the portfolio by subsectors, I would say majority of the portfolio is actually in real estate, which is about 50%, and about 20% in banks, and then another 20% in other kinds of sectors. So for example, like healthcare, which is Thomson Medical, insurance firms, FWD, Manulife, airlines, which is Cathay Pacific. Okay, so if you invest 200,000, or to be exact, 198,000, then the cash flows is shown here. So on the left here, we have the projected cash flows for a notional sum of about 200,000. So this is pretty much, this is of course indicative. It doesn't really show you, it's just to show you what kind of cash flows you'll be receiving in future. So one thing to note here is that for perpetual notes, we assume that the notes actually they pay in perpetuity. So they may not. So this diagram cash flow here, it does not reflect the call dates of the perpetual notes. So the actual cash flow can be higher than what you see here. So but anyway, if you look at the the cash flow projection, most of the bonds are expected to mature in 2021 and 2022. And then the portfolio yield to maturity is about 5.9%. So this is as of 24th of November. So just now, if you recall, I mentioned that you can actually customize your own portfolio and create a portfolio that actually pays out more in certain months. So this is, of course, depending on your own cash flow requirements. So anyway, I've listed down the coupon payment months of each of the individual bonds in the Bond Express portfolio. So for example, HSBC pays out in June and December, and then so if you have higher requirements during December, you may want to overweight maybe on this perpetual note, or in January and July for Cathay Pacific. So by putting a greater weightage on these bonds, you can receive a more cash flows in these months. Okay, so in the next couple of minutes, I'll be giving examples of what are some of the credits in the Bond Express portfolio. So it's just to give you a flavor, but of course, what I'm really advocating is that if you do not have a view of any issuer, then it's best to like equal weight and put your allocation equally weighted across all 20 names in the portfolio. So this name is I think is a famous name. I think is if you read the news, this China Evergrande is often mentioned. So they are they it's actually one of China's largest real estate developers. I would say the largest, if not the second largest. Um, if you look at the revenue has been increasing over time. So here it's still growing. So China Evergrande has increasing revenue. Its net income is still positive. So as of the trailing 12 months ending of June, there's about 21 billion of renminbi of net profit. And then the company also discloses its contracted sales on a monthly basis. So every month you can actually go to the exchange and extract the contracted sales for this issuer. So recently you see that they managed to sell quite a lot of bonds. So it's about 100, and they managed to get 140 billion of sales. So you can see that the contracted sales is actually increasing. And as for its gearing measures, we have two gearing measures here. So we have debt to total assets, and then we have net debt to total equity. So debt to total assets is one of the measures you can take for a certain issuer. So it's like measuring how much debt it has relative to the amount of assets it has on its balance sheet. Of course, you can also measure the gearing just by looking at the net debt to total equity. So in terms of net debt to equity, it's actually increasing. You can tell that it's actually one of the higher geared developers within the Chinese real estate space. So if you look at the range, it's pretty much towards the top end of the range. So China Evergrande pays a very high coupon, and if you look at the movement of the bond, it's very much in sync with the Asian high yield space. So this is this whatever happens to this company, I would say it will affect the Asian high yield space, because first of all, Asian high yield is a lot of it is in Chinese real estate, and then this being the biggest whatever happens to this company will have some impact on the Asian high yield space. And you can tell that just by looking at the credit spreads of the Evergrande bond and how it moves in sync with the OAS, the option adjusted spread of Asian high yields. So if you want to know, the option adjusted spread is about 1,900 basis points. So it's actually 1,900 basis points above the risk-free asset. And then if the yield to maturity is about 16%. So another issuer which we have is DBS. So this one, I think all of us are quite familiar. So DBS is one of the biggest banks in Singapore. So revenue has been going up since 1990. So it's doing well. As mentioned earlier, it's a investment grade, it's a high investment grade rated company. Net profit also going up. If you look at equity, is improving, and common equity tier one is also improving. So equity is something which we always track for financial companies. Common equity tier one is something which we track for banks. So common equity tier one is something like a measure of quality capital for a bank. So if you're investing in a bank bond, you may want to track the the level of common equity tier one. So here we have the CET1 ratio. So I compared DBS against against UOB and OCBC. So if you the chart on the left shows that the CET1 ratio is very high, so it's pretty much similar for all the three banks. So not much different, I would say, across the for capital adequacy across the three Singapore banks. But if you look at return on equity, return on equity is a measure of profitability, and profitability has been falling. So because of their higher provisions during the COVID-19, and which is why they are taking lower profits in the past couple of quarters. So the DBS 3.6 perpetual note is included in the Bond Express portfolio. So the G spread, which is a measure of the issuer's credit risk, is only 200 basis points. So China Evergrande is 1,900. So for DBS, it's about 200 basis points. So just for information, the indicative yield to next call is about 2%. So it's callable in September 2021. So another issuer which I mentioned earlier is Cathay Pacific. So this is a some sort of a vaccine kind of play. So in anticipation that we will have a vaccine in future, and maybe things will improve in future, then maybe things which are not that have not picked up over the past couple of months will pick up in future. So just to give you more information on the operating statistics of this airline. So if we look at passenger loads, it has dropped about 60% from a year ago, and but cargo is actually doing pretty well. So unlike passenger loads, cargo load is actually improving, and if you look at the number of arrivals. So we can look at the number of arrivals that are going to Hong Kong. If we look at the number of cases in Hong Kong, you see that the cases have actually been increasing. So that would affect their short-term revenue. And we look at revenue breakdown, most of it is actually in passenger services, about 40%, and then we have 46% in cargo. So this is as of June this year. And comparing the revenue to June of last year, you see that passenger revenue is actually declined from about 37 billion to about 11 billion. But it's almost equally shared now. So passenger revenue is actually almost quite on par with cargo revenue right now. So if you look at net profit, which is here on the bottom right. So net profit is down, and the estimated cash burn rate is about 30 billion Hong Kong dollars per six months. So okay, despite all these factors, the one thing that we should know as a bond investor is that there is adequate near-term liquidity. So in spite of the near-term downward pressures on revenues, on net profits, um, the the airline still remains in a relatively healthy capital position. So looking at looking at its current interest-bearing liabilities here on the right, we have about, I would say, 25 billion of uh, interest-bearing liabilities for the next 12 months. So there's the sources of liquidity is higher if we add the recapitalization plan and the investment in its associate, which is in Air China, and the value of its sources of liquidity is actually higher than its current interest-bearing liability. So despite of whatever is going on in its cash flows, the balance sheet is still pretty okay. So if we look at the bond, it's a 3.375 bond, which is in the Bond Express portfolio. The spread is about 600 basis points. The yield to maturity is about 6.4%. So this bond matures in 2023. So we still have some time to go in a couple of years. So I think by 2023, I would say I think it's reasonable to say that, I mean, the COVID situation will improve, and then maybe the passengers will come back. The passengers may come back and take this airline in future. So the last issue which I'd like to highlight is UBS. So UBS is a Swiss bank. So unlike DBS, most of its income is actually driven by non-interest activity. So non-interest activity is actually driving most of its total income. So this is the interest-related income. It's here, as well as the profit. So it's still profitable, 5.7 billion of profit in the trailing 12 months ending September. So as mentioned earlier, total equity is important for financial. So equity is improving as well as common equity tier one is improving. So if it's a Swiss bank, we compare it against other Swiss banks like Credit Suisse, Julius Baer. So CET1 ratio is still high, so above 12%, although it's falling, and that's maybe because of the provisions as well as the higher risk-weighted assets because of the modeling, and then you place more risk on those assets, and you get a higher RWA. As a result, you place more pressure on your CET1 ratio. But common return on equity is actually increasing. So unlike Singapore banks, you can see that the Swiss banks return on equity is actually going up. So the 5.875% perpetual Sing dollar bond the perpetual note is included in the Bond Express portfolio. The indicative G spread is about I would say between around 400 basis points. So the indicative yield to next call, which is in November 2023, is about 3.7%. Okay, so with that, I come to the end of my part. Hopefully, so I hope you can take away something. I illustrated that you can actually use the Bond Express to how to build your own portfolio. I also illustrated the benefits of diversification and also highlighted some credits within the Bond Express portfolio. And please follow us on Twitter, Facebook, and LinkedIn on bonds for the Bond Supermart team. Yeah, with that, I've come to the end of my presentation.
Yeah, thanks everyone for joining us. I hope you have gained some valuable insights for today's session. So if you have any further questions, do feel free to reach out to us on Bond Supermart or IGM, IFAS Global Markets, and we'll get in touch with you with an advisor. All right. If not, that's all for today. Thanks everyone for joining us. Bye.